We'll just dig right in. We've been looking at the 5 types of markets. And Jason Jankowski gives a really good overview of what the 5 types are. Because the thing about trends is they're pretty much the same whether they're going up or down. The difference is the direction, but what you have is a consistently imbalanced sentiment in the market. And whether you want to argue that it's being manipulated for us to follow or not, what we can generally say about a trending market is that the direction it's moving tells us which side of the trade is stronger at that time. So if we are in a secure uptrend, the buying side is stronger. That makes sense. That's what allows us to move up. This first sentence he says is something that as traders, we always have to keep in the back of our mind. Participating in a secure trend in price is the surest way to gain regular profits. Surest way. Part of understanding what makes a trend secure is understanding the issue of who controls the market on what time frame. A trend in price is created when market participants are equally divided along multiple time frames. And for the most part, they are all likely seeing the same things. So a really strong trend develops when you can find indicators across the 30-minute, the 1 hour, the 4 hour, the 1 day, the 3 day, and they have all moved into confluence. So what tends to happen is we have a downtrend, we turn, and when we swing into an uptrend, what you'll see is the quote-unquote bullish indicators starting to go off on the lower time frames, and it compresses up into the larger time frames. And once all the time frames start to agree, we have a really strong, secure trend. Okay, so he says secure uptrend and downtrends are basically the same market structure. In the case of uptrend, the bids are overwhelming the offers. Same thing in the opposite for the downtrend. He says when the trend is ending, you get range or reversal. Okay, so as we approach the end of a secure trend, one of 2 things happens. Either we start to make a bend for a turn, or we move sideways into what he's going to refer to as a range, but what we all know at Trade Crypto Live is as the pole. For me, the difference between a pole and a range is a pole happens on almost the smaller every time frames. A range tends to be on the larger time frames, tends to be a sustained up and down area that happens for a good period of time. And they typically touch both sides several times, top and bottom of the range. A pole can come in and out in a day, and it can show up on the 1 hour chart, but it still represents a break in the trend. When we're in a trend, we have an imbalance on one side pushing the market in a certain direction. When we fall into a range, balance has been restored, and we enter into the battle zone for who's going to break out up or down and who's going to be able to build momentum. So he says a secure trend is likely to end once the market reaches an important price level that winners think is where the market has run out of potential in that direction. So buyers, longs are starting to exit their positions. Because these traders often are professional participants and often are correct at the market turns previously before the existing secure trend is active, these participants will have enough order flow to stop the trend when as a group they think it's time. Until that point, the trend is secure. How secure is the trend? This is a question that should be on your mind every single day when you are trading with a trend. How secure is it? Because as you start to see the security of a trend break down, you have to start thinking about your risk management. Is it breaking down significantly enough that I need to pull my stop up? Should I consider getting out before break even? Should I protect my profits? Do I need to exit early because I got in, oops, and now I'm seeing the signs that maybe I got in right at the end of a trend? Whatever the case may be, as a trader, you need to develop the emotional fortitude to recognize that no matter where you enter the market, doesn't matter if you enter the bottom of a trend, doesn't matter if you enter the middle of a trend or in a range or at the top of a trend. At the end of the day, when the market starts to show signs that the security of your trade is breaking down, you don't get tough, you don't get an ego, you don't try and force the market by doubling down on your trade because you're going to move it up enough to convince people we're still going. You take what the market gives you, you get out of its way when it's time, whether you got in and rode the trend all the way or whether you bought Bitcoin at 20,000. If you had bought Bitcoin at 20,000 and you had followed a 2% rule, you would have been out the next day or within a matter of a week, and you would have had time to plan. Instead, we see this constant mentality propagating through crypto, and it's born out of the same mentality that came from the old financial markets. Buy it, hold it, eventually it'll be worth more. What they don't tell you is, unless you're wealthy enough to leave all that money alone and still have money set aside for your daily life, your emergency expenses, your rainy day fund, will you have the time to let your money sit until the market comes back to it? And unless you are one of those people that has, 7 figures sitting on the back burner, which they're out there, and if you have that, you have a totally different strategy available to you to trade. Unless you're one of those people, if you are a trader trying to build a small account into a large one, you cannot afford to sit upside down in a trade for years on end. You can't afford to, because what's going to happen is your tiny account is only going to get tinier, and you're going to have to wait months, years. If you got into Bitcoin in 2017, it's been 3 years and you're still waiting. Meanwhile, you have not made any gains off of that money unless you've been able to trade it on alt trades. But if you got in at 20,000 and you tried alt trading, I'm sure you're not having a good time at this point. So what we have to do is we have to answer this question: how secure is the trend? If I get in and all of a sudden I start to find out it's not very secure at all because everything shifts the moment after I click the button, get the hell back out again. Don't sit with the blood running down your arm or your leg, wherever you got cut, and watch it bleed. Go get the first aid kit, put on a Band-Aid, cut your losses, stop the bleed, and come up with a new plan. Now, why am I saying this? Why am I kind of giving you guys a little bit of the rainwater fire? I'm saying it because we are at a point in the market where we are going to see a lot of people fooled. Don't be one of them. If you took a bounce trade at 8,500 on Bitcoin, whatever the alt markets were doing, whatever you traded into, if you jumped in when you saw that 8,500 level bounced a little bit, and you're in trades right now because you took them, that's totally fine. But if the market starts to turn back around again, if the equities tank tomorrow and Bitcoin resumes its fall, you had better be ready to get right back out again and wait. And the biggest problem I see with people just starting out in trading, especially in crypto, is they are super ready to dive in, and then they have no idea where the steps are to get back out again. And as soon as they're upside down 10, 20%, 30%, what can they do at that point except cross their fingers, hope it goes back up, or get out? And most people who do not have the emotional fortitude, who haven't spent enough time studying markets to be able to get out, will freeze like a deer in headlights and pray to whoever they believe in for some help and some guidance. Don't be those people. Use your edge. Our edge is that we start from risk and we get out when things are turning on us. So the answer to that question, how secure is the trend, went off on a little tangent, but I think it was important, is based on observing a few things working together. They need to be congruent in their expression. 3 parts of market structure provide a reasonable agreement that a trend is secure: time, volume, and price. Now, I know what you're saying. You're saying we never time markets. That's true, but we can use time because it's on the chart. We are using it every single day as a means to measure price moving through time. So, that being said, he goes on to say, open interest in a secure uptrend is always rising until the end of a trend. Think about that. Interest in a secure uptrend is always rising till the end of the trend. I'm going to pull something up over here. Give me 1 second, because I want to ask you all a question, and some of you may have different answers, and that's okay. We don't all have to agree. What matters is that you are looking for you, and that you have an answer that you can use to trade off of while managing your risk. So I ask you this question now. Let me get my 4-hour. I want it to be a little bit of a, I mean, everybody probably knows I'm pulling up a chart. It's Bitcoin. It's okay. Okay. Clean chart. No judgments. No ifs, ands, or buts about it. And actually, I went to the 4-hour. I want to do the daily because I want to be able to see the volume comparisons here. Here we have, why do I have it on arrows? What I could argue is a secure uptrend just based on that one definition. Why? Interest was rising, volume was rising, showing interest rising, hype was rising, the fundamentals, the news that was coming out during this move was all pushing interest up. Okay. Then we had this happening, and we'll talk about secure downtrends. You can kind of argue that, or even if you ignore the big wick, you can argue that. So my question is, if we turned here, if this was our pole, this was our range, we bend our trend, and we turned, is the interest rising to show a secure trend? Now I'm just looking at volume here as a way to measure interest. But also, let's talk about the hype out in crypto. Has the last 2, 3 months, 4 months, 5 months, since the end of last year in November, December, has crypto been popping? Have people been shilling? Have they been hyping crypto to $1 million to the moon? Get your mom and grandma and dad to pull all their money out of retirement and buy it. Has interest increased into this move? If the answer for you is no, hopefully for most of you it is. If it's not, maybe you have something you can argue. But if the answer is no, that is not a point in favor of a secure trend based on volume and open interest. Now he says open interest in a secure downtrend is usually falling. So if it's rising, that adds credibility to the downtrend. Okay, so what he's saying is if interest in a downtrend is falling, that's pretty typical. But if it's rising, it adds credibility. How can I explain this in a really simple way? Because I don't like the way he worded it. It almost sounds like he's contradicting himself. But I know what he's trying to say to us. He's trying to tell us that in a downward move, I'm not going to use that dang arrow. In a downward move, especially if we've reversed, we probably are going to see interest decline as the move advances. But initially as the move goes into that trend in that direction, it starts to prove itself, we should see, and we can see this on the lower time frame, as the sharpest part of the trend was taking place, this secure trend here, what happened to the selling volume on that low period of time? It was confirming this move. And then as we pulled back on this bounce, this first big strong bounce that everybody said the bottom is in, Bitcoin's going to break this, it's going to 1 million, because look, we broke this trend. That's way too many lines, sorry y'all. What happened? As we pulled back off the downward move on the low time frame in the 4-hour, steep drop off in interest and volume. This does not show people coming to the table interested to buy a reversal. Okay, we've got that fresh in our mind. Let's go back over here now to our shorter time frames. What do we see? Let's get this a little bit taller here. As we're going up, volume and interest is going up. As we pull off, it comes down. Okay, so this is not suggesting that we're entering a secure downtrend at this point, but that we're pulling back and correcting off of a strong move. And in fact, if I were to just stop the chart here, and I were just to hide it here, I could make a pretty compelling case at this point in time that we have decreasing volume into the sell-off. That suggests that we're losing our selling momentum and we're getting set up to turn back to the upside. We did not do that. We got a little bit of a bounce here, but right after that bounce, what happened to volume? For the most part, it's flat. Once I cut this volume part out, what do you see in the spikes? They accelerate as we push down. And the significant spikes are the strongest pushes, probably the people that are pushing the market the way they want it to go. Okay, that's a lot of fun. Take all those lines off this chart. Now let's really dig in. Let's dig into where we're at now. Hopefully you all are getting a little bit of enjoyment out of this, seeing kind of how my process goes, digging into what's going on. We should see turns happen on lower time frames that compress into larger time frames. Here we had price up. Right about here we went sideways. Here's where we really break down. As we are heading into this move, coming out of the bottom here, notice some volume came in, a little bit more. We're kind of holding it together. This little incline here had some volume supporting it. But really, over time, the big picture of volume is pretty much here. And only when we're moving in the direction do we see the spikes appear up above it. So what changes right about here? These little guys. And with these little guys come these big guys. This volume all the way back to my cleanness. Sorry, I use hotkeys. I'm not like Scott, so you all got to bear with me while I click, click, click back. As we slide into this move, look at that. That to me says interest is rising into the selling. This is confirmation for me that this is the direction we're trying to go now. What do you see on this pullback that's started to develop? Divergence. Price pulls back, volume drops off a cliff, selling and buying. If they truly want to start pushing us back up, whether it happens here or whether we make it back down to here or even all the way down here, what we want to be looking for on this lower time frame level, whenever this occurs, is something to suggest that with this price increase, volume is going to go up as well. We want to see the interest supporting the move. I haven't seen it yet. So far, all I've seen is in the last 3 or 4 days, along with equities, selling showed up. The big boys came in with their sells and dumped a bit. And you can even see when I zoom out a little bit, there's that little bit of an upswing as we swing down. Scott was looking a little bit over here, right? Now, what's the problem here? Oh, don't look at my my fibs here. Scott won't like them. They're a little different than his. Whatever. I'll show you. I don't care. I got on the S&P a potential for a 4.3 there, where Scott's 1.6. But we know fibs and fibs and fibs, right? So whatever. But what they don't give us here is volume. A lot of times in traditional markets, you got to pay extra for higher levels of data. Crypto hasn't gotten quite to that level of advancement yet. So you have to go to another broker or a different, slightly different chart. They might have it on the Vanguard. Vanguard has their own that kind of follows like almost like an ETF fund that follows the index. And you can see volume better on Vanguard. So what do you see with this dump here? And even if you want to argue that that was part of that, let me just stretch it out here for anyone who might naysay that this doesn't really show us that strength is increasing into, oops, don't delete the volume. Strength is increasing into the drop to suggest we may have hit a turning point. Could they suddenly turn off the selling, bounce at this red moving average here, turn back around? Yeah, why not? But the more that these events that are taking place outside of the control of the market, the virus, the stuff that's happening that can really affect commerce and affect trade and affect the economies, at some point, the external influences on the market are going to overpower the lower time frames, and we get these significant moves. We just saw that take place on the equities markets in the past 3 days. So, if you can determine with interest and volume that we are supporting a move, that is, interest is increasing into the move, whether up or down, you are confirming a little bit that you may have a secure trend. But we have another thing we need. We need a lot of time. A secure trend cannot develop without first making a top or a bottom, as described previously. And then in the case of a secure uptrend, a bottom has to be in place, and the structure must have been described in bottoming markets. This is the part that really got me when I was prepping for this. In other words, a secure uptrend cannot form unless there has been a bottom and the structure of the bottom was professional against professional with little interest from small traders, the public. Now, you might say, but Jankowski never was trading crypto. And you may be right. But can you go back to the mid-December 2018 lows and say the little guys gave up? It was big guys fighting big guys. They had enough time to adequately position all their money into the market the way they wanted. Enough time for people to think Bitcoin died. If there is not enough time to support your secure uptrend and you don't have that bottom or that top, in this case a bottom for an uptrend, to prove that you have built the structure needed, all I can say is good luck. Good luck. Because it takes time for the market to begin moving higher. Smaller traders need a lot of time to confirm the bottom is in. They're watching and trying to decide if there's an uptrend in place. Okay, so we had everybody, think about all the little guys that were watching and watching and watching at 3,600. Think about all those guys and how many of even us in Trade Crypto Live, I talked to plenty of people who were just starting out who would not jump in there because it wasn't low enough or they weren't sure it was going to turn there.
It was going to 1,000.
It was going to 1,000.
They told me so.
They told me so. During that time period, can you make an argument that professional traders were able to position and create proper bottoming structure that if the market were to try to return to, they would be willing to protect? That's really what it comes down to. Because the big boys get their positions in at a place where they are sure that they will keep the market from returning to until they're ready. They know where the turns are because they make the turns, not because they're looking for them. They don't need to look for a turn. They click a close and reverse button and they print it on the chart for you to follow. So in a secure uptrend, I'm going to wrap up this uptrend. I got too excited about this. I got in too deep with the trending. We'll go into downtrends for our next meeting, and then the one after that, the final one, we'll do ranges. We'll put this out into a whole 5-part segment. It's going to go into the foundations course because all this stuff is really critical to understanding markets and what happens in them. So real quick, I'm going to wrap it up and I'll pass back to you, Scott. I'm almost at the end. In a secure trend, volume and price become more closely related. Volume should be increasing above the average for that market when the market makes a new price level in the direction of the trend. That means volume should spike when the uptrend reaches a new monthly high price, for example, or volume should spike when the downtrend drops to a new significant low. So, before I pass it back, I'm going to get off of this this one here and go right back over here. Do you see the difference? David's okay. In volume spiking versus not spiking, or if you thought that the turn was here versus not spiking. Look at this spike telling us that we've turned here. Where's the spike telling us we've turned again? If it's not behind you, Scott, it's got to be in front of you. It's got to be there somewhere. So that leads me to believe that still we are looking for that turning point to the downside at this point in time. Should a significant amount of volume show up, start to build us and push us in the other direction, that could change. But what he says here is that in secure uptrends and downtrends, the market is not time compressed. Time compression results from a change to belief structure. That's what we talk about when we see we're going up in a trend and we hit that pole, we wind it up like a spring and we coil up. That's the market getting time compressed. And the reason why flag patterns and pole patterns tend to have a long drop in followed by a long drop out, or a long bump in followed by a long bump out, is because during the pole, when we're grinding that area, we are compressing the beliefs of the market. And when we exit it finally, the beliefs have hit that breaking point. They explode like a dam that's finally broken open. That's the whole idea of time compression that he's talking about through this whole book. And when you're talking about a secure trend, you're talking about a non-compressed market. As soon as we hit that wall, I'm gonna look at this real quick. Here we come with a turn. This is the market getting compressed. As soon as we break, notice the high volume down bars. The compression has been broken. The Kraken's been released. We get a bottom with a spike in volume. Nice. It's pretty long considering related to everything else on the chart, although kind of small, but this is silver and we're on weekly, so you could zoom out more if you wanted an even bigger trend. But then we turn. We get interest slowly increasing. Now notice it's not a perfect straight up. This looks a lot like what you see on Bitcoin, but you can still see the average volume slowly starting to come up and get bigger and bigger. And then what happens here? Would those of you paying attention right here think that this was a turning point? I'll tell you right now that I certainly would think that they had hit a turning point and that silver was getting ready to go back down, possibly at this area. Because if you look left, here's the pole, you came back to the pole, you got to the top of that area, volume took off, and boom, we lost interest. No reason for it to really go higher. It's not until we get down here and we start to build up after this freak. Looks a lot like crypto. Nice, nice, nice. Freak them all. Now we're building interest into the move coming off of the freak. Now maybe they're ready to resume. So all these pieces have to come together for you when you're looking at these charts. You have to understand that a single trade is not just a single trade.